credit issuers are constantly asking us for credit checks and to be personally liable for the debts that we're taking on for our business. Like, when is our business ever going to be able to fund itself and stand on its own? Well, it's actually easier. It can be faster than you think it may be. You just have to know the right steps to take to set up your business where you can actually get away from a lot of these personal credit checks, get away from personal liability, and actually allow your business the opportunity to fund itself. So that's exactly what we're going to be diving into today. Today, we're going to talk about how to protect your personal credit while growing your business, how to strategically use personal guarantees, how to strategically use personal credit checks, when you do need to use them and when you don't need to use them. Hint, you don't need to use them a lot of the time, and how you can still get the money you need to grow your business regardless of personal credit quality and without taking on the personal liability. So we got a lot to cover. Let's dive in. If you're just coming in, give me a shout out. Tell me where you're coming in from, and I'll give you a shout out right here on the stream. It's like free advertising, free publicity, like premium coaching for new tax pros is in the house from YouTube. Hey, thanks for coming in and saying hello. Drop a line right now and tell me where you're coming in from and give me your company name. Okay, so how do we protect our personal credit while growing our business? Well, there's a few steps we want to take. And let's think about this from the big level, right? We know that people like Michael Dell wasn't personally guaranteeing Dell's debts, right? So, and we could give this example for anybody. We know Steve Jobs wasn't doing it for Apple, for example, as well. So what happens is eventually a business grows a credit profile and grows itself to a point where it doesn't need the owner to provide a guarantee. So we know it's possible. We know that these big companies, their owners aren't doing it. So we know that there's a place along the way that we can get away from it. The question becomes, like, how are they doing it and how do we do it, right? Is it just because they're big that they get away from guarantees? And the answer is no, they don't. Actually, it's that they followed a series of steps, which, interestingly enough, any small business can also follow. And along that path, they started getting away from the personal liability, getting away from the personal credit checks until eventually it was all gone. You could do exactly the same thing. As a matter of fact, you could follow the exact same steps to do what big companies did. They followed the same steps to get there. Okay, and it's great because one of my favorite passages in Steve Walton's book, when he talks about the founding of Walmart, is he specifically talks about how in the beginning of his business that he would go to buy stuff from wholesalers and they would go to the back to check his Dun & Bradstreet credit profile. And he would know it was good and they would give him credit line and he would buy his stuff. To this day, Walmart has more accounts, more trade lines than any company I've ever seen. And it's interesting because you can see in his book that even the largest of companies started on the exact same path you can start on to get away from personal guarantees, personal liability, using personal credit to fund the business. So what steps do they take? Well, here's the order of the things you want to do. First, you have to establish a separate business entity. I know it sounds crazy, right? But the reality is a sole proprietorship, you are the business. So you have to separate your business from yourself. And that starts by getting like an LLC, a corporation, a partnership, anything other than a sole proprietorship. If you're a sole proprietor, the problem is you are the business. You'll always be the business. You cannot separate personal credit or liability when you are intertwined with the business. So you have to set up a separate entity for the business. And that means that you need to actually set up preferably an LLC or a corporation. There's many types of corporations out there. Most are familiar with the two types, S and C Corp. It doesn't matter which you choose. It doesn't matter if you choose corporation or LLC. Just set up a separate entity, preferably an LLC corporation. That's what lenders and credit issuers like the most. And if you do want to choose from a lender's perspective side, they like corporations the most. Doesn't matter if it's an S Corp or a C Corp, but you've got to separate that entity. Now, the next thing is you have to get an EIN number for that business. Now, surprisingly, you might say, well, isn't that common sense? Everybody does. No, they don't. A lot of sole proprietorships don't have EIN numbers. So you can actually have a business without an EIN. But the EIN is as important to you being able to separate you from personal credit from your business as it is like, you having a social, right? So your social security number is built, your consumer credit report is built and linked to your personal social. Well, business credit reports are built and linked to your business EIN. So the first thing we have to do is if we don't have an EIN, we can't even start the separation of us from the business because the business still isn't seen as a real thing in this country. Right. So if I'm born into this country, then I'm given a social security number. That's how the government knows that I am a citizen of the United States. Now, if I create a business in the United States, I need to get an EIN number. That's how the government knows that I actually have a real business. The business really exists. So this is just basic stuff, right? We've got to set up an entity, preferably an LLC or corporation. The next thing is we've got to make sure that we have an EIN set up. Now, for me, the next step in that process is to go and get a business bank account. Side note, at this point, I'm anticipating you already have the other stuff separated from you personally and the business. What I mean by that is that, like, you've got to be able to get an address set up that's separate from your personal address, right? No home address. We want to use a virtual office, or we want to use a real retail location or a real commercial location. It needs to be separate from our home. We need a separate phone number for the business, right? It cannot be our mobile phone. It cannot be our home phone. We need a separate website for the business that shows professionally what we do. We need a separate email for the business, right? An at mycompanyname.com email, not a Gmail, AOL, anything that looks like a personal email. It's got to be a legit business email. We need a license for that business if we can get one. These things are just showing that the business is a real, credible thing, right? And so that's what we've got to do. We got to start building that business just perception-wise, where it looks like legit and credible, right? A legit and credible business has a professional email address and a professional website, and that probably has a license, right? It has its own entity, it has its own EIN, it has its own phone number, it has its own address. So those are just basic fundability things you want to get set up in the beginning to be able to even start the process of separating you from your personal credit from the process. And Dwayne, thank you for coming in. I appreciate you being part of the community. And Candy, thank you coming in from Texas. Dwayne says, hey, what if you did a PG on a business loan and defaulted on it? What's the worst case scenario? How can you move forward? I love that question. I want to pull that up. So look, if you do provide a personal guarantee, let me tell you from experience. I'll tell you what happened to me. I provided a personal guarantee for a Bank of America line of credit. The mortgage crisis occurred. The mortgage business went down. Now, at that point, what ultimately happened was they came after me in the courts for a judgment. I couldn't fight because I didn't have the money for attorneys. They got the judgment by default because I didn't fight. With the judgment in hand, they then had the legal right to take all the money out of my accounts. Now, since I banked with Bank of America, it was super simple for them to do. So the very first thing they did was just cleaned out my bank accounts. My bank accounts went to $0. Actually, it's not accurate. It went to negative because, I had checks outstanding. So when those checks started to clear and they took all the money out, the checks all started to bounce. So it was a complete mess, right? And then you go into check systems and then it becomes a whole nightmare. So that's one of the things that can happen. And my advice is that in this case, when Dwayne said this, hey, if you defaulted on somebody you have a bank account with, change your bank. It's the first lesson I learned. You gotta get a new bank account than the bank. Because the problem there is that if you do default on something and you have a bank account with them and they get a judgment, they will clean out those bank accounts to pay back that business debt. So that's one of the first things that can happen is that they can come in and literally clean out your bank accounts if they get a judgment allowing them to do so. And to fight that judgment is not a cheap thing. Now, next, you get a judgment against you. So if you default on a business debt you personally guaranteed, now you have a judgment against you. And those judgments will eventually have to be paid. And what I mean by that is this. You see, a lot of people are under the belief that a judgment stays on a credit report for 10 years. That's just not true. They actually, public records are a mess right now with the consumer reporting agencies. But all your judgments lives for its lifetime on a place called LexisNexis. So whenever you go to apply for a loan, personally or business, they see LexisNexis, they know you had that judgment outstanding, even if it was 30 years from now or 30 years ago. So now what happens is that judgment will have to be paid in many different situations. First of all, if you ever go to get an SBA loan or a really nice loan down the road, like a long-term low interest rate loan, you'll have to pay it back. I did. I had judgments from the mortgage crisis in 2006 still come up in 2023 when I'm getting financing. Now, I paid those off and I can prove I paid those off, so it's not a problem. But keep in mind, that was 2006, right? So you're talking about like 20 years ago. I'm still required by SBA lenders to pay off judgments from 20 years ago if they weren't already paid off. If I go to get a home loan, if I go to get a lot of other things, personal loans, they'll also make me pay those judgments off. So eventually, once they get a judgment, it's going to haunt you until you get it removed from LexisNexis or you get the thing paid. So hopefully that gives you a very detailed answer of what happens when you don't provide or when you do provide a personal guarantee. You default on the business debt, it goes bad, they come after you, they get a judgment, then they have the ability to come after any of your personal assets in court. And I've had that happen. Through the mortgage crisis, I went, they got a judgment, then they started soliciting me every 6 months, making me submit my financials to them to prove that I had money so they could garnish my wages or do anything they wanted to do to get paid back. So the worst thing that happens is they get a judgment. Once they get a judgment, they have the court authority to start coming after your assets, and they can come and ask you for updates of your financials every 6 months if they want to keep hounding you until you have money to pay them back. So if you do default on something like Dwayne says here, and you did have a business loan you defaulted on, you want to fight it as much as you can to not get that judgment, because once you get that judgment, they can come after you for anything to get the money back that they owe you, and that can haunt you when you win any kind of personal or business loan. Now, hey, Julian says, hey, at the corporate builder is in the house. What's up? Good information. I appreciate that, Julian. And Dwayne says, thank you very much. You are welcome, Dwayne. So the next thing is we've got to separate our bank accounts, right? So far we've talked about separating the business entity, the EIN, the address, the phone number, all that stuff. The next thing is we want to separate the bank account. We need to go get a bank account open for the business. Now, when I set up a new business, I go in, I make sure the name's available. Then I get the phone number. Then I get the address. Then I get the domain. I get all that stuff. Then I set up the Secretary of State records. And that way, all my information is put in Secretary of State accurate. A lot of people set up their Secretary of State first. Then they try to go back and they get an address and a phone number and a website after, and they never go back and update it. I like to get all this stuff done before I set up the entity to make sure it's all congruent, to make sure it's all set up right. But when I set up the entity, literally within an hour, I set up the entity, I go get the EIN, I go set up a bank account at my bank. I do all those 3 steps within an hour of setting up that entity, and for many different reasons. Because first of all, it separates you from the business, right? Now we've got a separate bank account for the business. Now we've got money potentially coming in and out of that bank account. Now the business bank account is separated from us personally. A lot of banks, if you go to get a credit card or a loan from them, you exponentially increase the probability you'll get approved just because you have a bank account, okay? One of my good buddies, Brandon, he charges like $15,000, $20,000 for a coaching course to teach people how to stack funding. And the premise of what he basically does is he has people go and open bank accounts at all these different banks. They work on improving their personal credit. Then they go and start applying for mass credit cards and loans all at once at all those banks, knowing that they have an exponentially better chance of getting approved if they have a bank account open at that bank. So there's just a lot of benefits. Your check system's credit score takes into account how long you've had your bank. Your business bank rating, which gives the likelihood that banks will lend you money. That is based in part on how long you've had your bank account open for as well. If you ever change ownership of your business, they'll look at the bank account start date as the starting date of the business. There's so many things that are linked to the start of the business bank account that you need to get it done right away. Like when I get my entity and EIN, it's so important that immediately you should get that business bank account set up. Make sure your address, your phone number, all of those kind of things are congruent on that, along with the rest of your records. Now, next, you want to start obtaining business credit cards and business credit lines in the business name only. So what we need to do now that we've separated ourselves from the business, now that our business is its real thing, its own address, its own phone number, its own website, its own license, its own bank account, it's different. It's definitely different from us. Now we need to take this different thing we've set up, this entity, and we need to start building its own credit report. The credit report is really the key aspect here. You see, if you ever want to get away from personal credit checks, then and leave your personal credit safe and get away from guarantees, we've got to show lenders and credit issuers that this new thing we set up, the business, is good. It can stand on its own. It can pay its bills, and it can show a history of its paying its bills. See, if we don't do that, they're going to always want to look at our personal credit because it's obvious, right? They want to issue a credit card, a loan, or a credit line. The one most important thing that all lenders and credit issuers care about is your likelihood to pay them back. So the easier to look at how you've paid others back, right? It's real basic. We understand that. So if they can't look at your personal credit and you don't have any business credit, they're not going to give you money because they don't have any history to look at. So what we need to do now is we need to give them history to look at to prove that our business can pay its own bills. And when we do this, then they stop relying on us as individuals because they know the business is doing it. Now, this is where I often say the business fund itself. because what we're ultimately doing is building a credit profile and a score for the business. Then as we build this thing up, more and more lenders and credit issuers will give us money because this credit report is good and it validates that the business can pay its bills, right? So the more history we establish for the business paying its bills, the less likely they're going to need our personal credit, because they don't really care how we personally pay our bills if the business has this long track history of paying its own bills. So we've got to start building a credit profile and score. But the very first step of that, as we've already taken the first steps. We did all that fundability stuff. The next thing is we need to start getting credit that reports to the business credit reporting agencies. Uline, Quill, Granger, just to name some of them, right? Quill's not as much a starter vendor anymore. Uline and Granger are two of my absolute favorites. You could even use CEO Creative as another one, for example. So these starter vendors will give us credit when we have none. And so we want to start to go out and get credit cards like this that report to the business credit reporting agencies. Now, maybe you do have good personal credit. Maybe you want to jumpstart the process. If that's the case, you want to get a program called Credit Line Hybrid, and I'll pull that up on the screen for you right now. Now, this is where you can get like a lot of high limit credit lines for your business. And these credit lines that you're actually getting for the business can be used to be able to build business credit. So if you have good personal credit, you can get business credit cards that report to the business credit reporting agencies. And then that'll help jumpstart your credit report, because now all of a sudden you got $10,000 to $20,000 credit lines being the first accounts that hit your business credit reports. If you don't have good personal credit, then you want to go to what are called starter vendors. We want to go to Granger. We want to go to Uline. We want to go to CEO Creative. They sell stuff we need. They will report the credit that we give them to the business. They give us to the business credit reporting agencies. And then at the exact same time, they are also able to give us the credit without a personal guarantee. So we're able to get credit without a personal guarantee. It reports to the business credit reporting agencies, and we're able to start paying those bills and getting those accounts to report on the business credit reports. Okay. Now, Wesley says, hey, if you want to set up a nonprofit, is it the same way? Yeah, you can. A nonprofit at this point follows the exact same steps of everything I've said. It doesn't matter if you're for-profit. It doesn't matter if you're nonprofit. You still want to separate yourself from the business like we discussed. Then you want to start getting starter vendors that report to the business credit reporting agencies. Everything at this stage, Wesley, is exactly the same for a for-profit as it is for a nonprofit. And Julian says, do you have this information in Spanish? Email us, info@creditsuite.com. info@creditsuite.com. The short answer is yeah, we have almost all of our marketing materials for our partner are in Spanish as well, so we can definitely get you some Spanish assets. And hello, y'all, I'm new here. R Lake 13, thank you very much for coming in. Okay, so now we start to get accounts that report to the business credit reporting agencies, right? We get a Uline, we get a Granger, we get a CEO Creative. We go in, we get those accounts, we pay the bills as agreed, and then we start watching them report on our business credit reports. Now, you can go to creditsuite.com/monitoring. That's creditsuite.com/monitoring to get access to business credit monitoring. So now we want to watch these accounts reported. When one account reports with Experian or one account reports with Equifax, they'll create a credit report. If we paid that bill on time or early, it'll give us a good score. It'll take 3 accounts reported to Dun & Bradstreet to do this. So once we get one account with Equifax and Experian or 3 accounts with D&B, now we have a credit profile. Now we have a credit score. Now we have some kind of limited history to show that we pay our bills as agreed. From that point, what we want to do is continue to get more and more credit without the personal guarantee and credit check. We want to start going to retailers like Amazon and Staples and Office Depot. We want to go to Best Buy. We want to go to Apple and Dell and HP. We want to look at the stuff we need to buy in our business, and we need to go to the retailer we normally do business with anyways, and we want to start soliciting them to get a credit card without a personal guarantee. Now, again, if you've seen our software, we make it super easy. We map all this out for our clients. They walk through a business credit builder step by step. They only see the accounts they're actually going to get approved for, so it makes it easy. If you're not working with Credit Suite, you're doing this on your own, you can still do it. It just requires more time because you're going to have to contact these credit issuers to make sure that you can actually get approved. Or you'll have to apply and get denied and keep applying until you find the ones to get approved. You see, that's because of what's called a tiering system. And here, I'll show it to you. So a tiering system basically is the fact that lenders or credit issuers have tiers of credit you can get based on a certain amount of approvals. Here, I'll show you what I mean. So what I mean by that is that when you have a certain number of accounts, it opens up other accounts for you. So this is our fundability software, for example. This is how we help our clients build business credit, right? And so if we come here to our business credit builder, we see what we call tiers: tier 1, tier 2, tier 3, tier 4. And so what this actually means, and my screen is shared. I think that was Carl that did that. Thank you, my fine sir. So this is basically a tiering system of credit you can apply for. So for example, if I go to tier 1, 3 vendors, I need these I can start to get approved for right away in tier 1. Well, then in tier 1, like JJ, Gold, or Uline, these are ones that I can start to get approved for right away. But if I want to go to get tier 2 or tier 3 or tier 4 vendors, well, then these are accounts that I need another greater number of accounts to get approved for. So Valvoline, for example, I'm not going to get approved for Valvoline unless I have 12 accounts on my business credit reports. So what you should know about tiers is this. The tiering system is based on how many accounts you have on your business credit reports. Like tier 1 is like 3 accounts, and tier 2, I think in order to get here, you have to have 3 accounts from tier 1 to get here. Then you have 6 accounts to get to tier 3 and 12 accounts to get to tier 4. So what I mean by that is that the more accounts you add on your business credit reports, the more tiers or types of credit become available. Now, eventually, in the end, you get to a point where you're able to get approved for auto financing. And I'll give you examples. We had a client get $350,000 in auto financing without a personal guarantee, without a personal credit check. It's not even linked to them personally. It reports their business credit reports, not their personal credit reports. But a client get $200,000 in auto financing, same thing, right? I mean, one of them was like, I just went to get a truck loan, and it was so high that I literally created a Turo business because I could get all the money. And eventually you get Visa cards, you get MasterCards, you can use anywhere without a personal guarantee, without a personal credit check. So again, the key of what we're doing here is we're basically coming in and starting a credit profile and score. Then we continue to build more and more and more on that credit profile, showing a bigger and bigger and bigger history of us being able to pay our bills. As we do this, the credit issuers are giving us higher and higher and higher approvals. We get $200,000 in auto financing. We get a $100,000 credit line. We get a $50,000 credit card. So now the amounts that we're getting are going up and up and up and up. And this combination of adding more accounts to our business credit reports with higher and higher and higher limits is what's showing credit issuers and lenders that we have this vast history of paying our bills as agreed. And it shows, hey, we're spending $5,000 a month on this account, $2,000 a month on this account, $3,000 a month on this account. So credit issuers now say, okay, look, here's a business that has a credit report, has done all the things needed to get a credit report. Now it's getting a lot of different accounts. The accounts are being paid on time or early. The credit issuers are raising the limits and the approval amounts higher and higher and higher. And the next lender, the next credit issuer that comes down the pipe, they see that, then they start to approve you without the guarantee, without the credit check, and again, for higher and higher and higher amounts. The key is to give them a history showing that we can pay our bills responsibly. Then our business can get away from personal credit checks. We can protect our personal credit. We can protect ourselves from personal guarantees because the business has proven that it can stand on its own without us. The business can qualify for the credit. The business can qualify for the financing. It doesn't need us to do so. And the more we continue this process, eventually we'll even be able to get loans. We'll even be able to get credit lines without a guarantee and credit check, the same as Walmart does, the same as Apple does, right? The same as any large privately or publicly owned company. It's just we've built it, and as we build it, more tiers of credit become available without a guarantee and credit check. Then we get to the final tier. Now, every credit card, almost every credit card that's in the business world, we get now with no personal liability, no personal credit check, right? So now we're getting credit at every major store, every major fuel station, Visa cards, MasterCards, auto financing, credit for airlines, and credit for Southwest, American Airlines, hotels, Marriott, Bonvoy, all that stuff we can now get without the liability. Now, once we've done this, now we can start to get loans. Now we can start to get credit lines without that personal guarantee and without that personal credit check as well. So it kind of gives you an idea of how that process is working. Now, Joey says, hey, can we use the credit in Mexico as well, like Home Depot? You can use the credit anywhere that you want to use the actual credit. Now, unless your credit card issuer has a problem with you using it out of the country, you absolutely can use that same credit out of the country as well. And Synergy SRT says, should you apply to multiple credit accounts at once if approved to not delay the approval? AI process, if you apply to the cards, you can apply for multiple credit cards at once. It's not going to hurt you because unlike consumer credit, where inquiries account for 10% of your scores, inquiries count for 0% of your business credit scores. So you can apply for 30 different accounts today and be fine. Here's where you've got to be careful. You've got to be careful when you're applying for credit cards that are underwritten by the same provider. So let me give you an example. Fleet credit cards are oftentimes underwritten by WEX. And so if you go to get a BP, a Chevron, a Sunoco credit card at the same time, all those approvals, even though they're offered by different gas stations, are underwritten by one company. That one company sees multiple applications from you through multiple providers. They immediately shut down all the credit because it's fraud. So you've got to, if you're applying for a credit card that's underwritten by the same company, like in that case, WEX, you'd want to spread out a week or 2 weeks before you apply for another account, just to make sure that they don't see you mass applying at the same time. But as long as that's not the case, you can apply for as much credit as you want. It's not going to hurt your credit. Great question, Synergy SRT. Okay, and how frequently do you need to use their tier accounts? Well, another great question here. So the business credit reporting agencies will count an account into your score if you've used it one time over the last 12 months. I recommend to my clients that they do it every 6 months. So I recommend to clients that if you want to get history for using these accounts, you should be using them at least once every 6 months. And I say that to be safe. The reality, the real recommendation from the business credit reporting agencies is you should be using once every single year. Synergy SRT says, should you apply? Okay, and we already answered that question. Okay, and you got it. And Pierre Robert Sempure, thanks for coming in. I appreciate you saying hi. All right, so now we are on a roll. We have set up our business where it's credible. We've separated our business from ourselves. We've now started to come in and build business credit. So the next thing that we want to do is we want to start limiting personal guarantees at this point. We need to start saying no. So at this point, any credit card we go to apply for that they ask for a personal guarantee, we ask them, do you have one that's based on my business credit quality and not my personal? And we can strategically decide if we want to apply or we don't. Okay, I got a PNC Bank credit card application 2 weeks ago. I liked it. It had everything that I wanted it to have, or about 2 months ago. And I called them and said, hey, do you report to the business credit reporting agencies? Will you approve based on business credit quality? They said no and no. So I said, this credit card isn't for me. I no longer will take those credit cards that are linked to me personally. I'm only now taking the ones that are linked to the business. I now have that option. Now, when I start to get loans, I'm asking them the same question. Hey, do you require a personal guarantee for this loan? Now, at this stage, some loans I can get without a guarantee. Revenue lending, merchant cash advances, equipment financing. And some other ones, I'm probably still going to have to provide a personal guarantee. SBA loans, until I get more credit established. But at this point, I'm able to start getting away from loans just by strategically asking if I need a guarantee. And if they say yes, then I'm going to ask around in the same industry. Hey, if I'm going to get a revenue lending loan, a loan that's just based on my revenue, then I'm going to ask the lender, do you require a personal guarantee? Yes, I do. Okay, great. Talk to another lender. Do you? Yes, I do. Okay, great. Do you? Yes or no? No, I don't. Okay, great. So now I know that there are lenders that will do that without a guarantee, and now I'm strategically choosing lenders that will let me get around the personal guarantees. Now I'm strategically using my personal guarantee when I have to, SBA loan, and not when I don't have to, business credit card. So now I'm going to start to strategically use those personal guarantees. Now, of course, along the way, you've also got to make sure that you separate your business and personal expenses. It's why we set up the business bank account, right? We got to start separating our money. The income that comes into the business needs to go into a business bank account. The expenses that get paid to the business need to go out of a bank account. We need to show that we've got a bank account and that a business is legitimately running and money is churning, right? Money is coming in, money is going out. Okay, that is going to go a long way to helping us get loans and credit lines, because now they can see that we have fully separated ourselves from our business. Our business has its own credit report. Our business has its own address and its own phone number and its own license and its own entity and its own EIN, right? And now all of a sudden it has its own bank account. All the expenses and the income is going into the separate from us. And now lenders are really starting to see that we are separate from the business, and we can start getting away from personal credit checks and personal guarantees. Now, the other thing is, now we're going to probably start considering getting insurance as well. So there's a lot of insurance that we probably want to get to protect the business now that it's becoming something of value to us. There's something called key man insurance. That's if something happens to me, then my company gets a bunch of money to replace me, right? As bigger business gets bigger, it becomes more important, right? There's E&O insurance for errors and omissions. You might make mistakes. Somebody on your team might do things. You might get sued. There's E&O insurance for that. I mean, there's 50, 100 different kinds of insurance for the business. So if you have a good, reliable insurance provider, talk to them about it. Hey, I have a business. This is the stage it's in. What insurance do you recommend? Now we start to insure the business itself. Look, I do some interesting things to protect assets. And here's what I do. I'm not saying you have to. I'm not an accountant, not an attorney, not legal or accounting advice. Here's what I do. Every vehicle I own, I'm a pilot, I own a plane, a little seaplane, lands on water, love the thing. It's my favorite hobby, right? So I have cars, plane, at the same time, houses. Every single one of those assets is owned in its own separate entity. So I have every single asset is owned in its own separate entity. And then that entity has its own umbrella insurance policy on it. So my entity that houses my car, for example, well, that entity actually has its own insurance policy on it, and that's it. I don't do anything else to the entity. It's never used for anything else. The entity owns the asset, the car, and then I have an insurance policy, which isn't very expensive, on the actual entity itself. Now, why do I do this? Well, let's just say that, I'll give a couple examples. My son is just about to get his driver's permit. Scared to death. It's about to happen next week, right? So if my son goes out and makes a mistake, gets into an accident, let's say somebody dies, right? Well, or the same thing happens to me. Maybe I go out and get an accident, somebody dies. Well, then obviously that's going to be a pretty potential big lawsuit, right? Something serious injury, somebody passed away, something happened. Now the other person, the victim's family, whatever it may be, they go and get an attorney, and that attorney is going to sue anybody and everybody they can to try to get paid. Even if I had nothing to do with it, right? I'm sitting here working, talking to you live, and maybe something happens. Somebody else is out driving my car, like one of my kids, and something happens, and it's my car. I could potentially be liable for that, even though I wasn't even involved in the thing, right? So now what happens is they have the entity owned, the asset, the car is owned by an LLC. Does that mean I'm completely not liable? No, they could still try to pierce the veil of the LLC and get to me, but it's not an easy task. It definitely threw up a big barrier in their way, and they're like, what the heck? Like, now I got to go through an LLC to even try to get to the individual. Most attorneys wouldn't even try to do that. But the other thing is, I have a carrot. My carrot's my insurance policy. It's like, hey, why would you ever want to come and sue me when I have this beautiful entity here with a $2 million umbrella insurance policy? Why don't you just sue the entity and go after the entity's insurance? Right now, there's way more likelihood that they're going to sue the entity and go after the insurance money for the entity, and I'm going to be safe because they're going to want the entity's $2 million insurance policy versus trying to pierce the veil of the LLC and try to get to me. So that's why I do it. It doesn't completely protect me, but what I'm doing is I'm giving them a big barrier to try to get to me, the LLC, the entity that the assets own, that I don't even own my cars, anything. It's all owned by an entity. And then they're going to have to get through that to get to me, which they probably don't want to do. And then why would they want to get to me when I have so much insurance, more insurance on the LLC than I do as an individual? So I'm enticing them to sue the entity. I'm enticing them to go after the entity's insurance. And I don't care what they do because the entity's sole purpose in this world is just to own that asset. So maybe that helps you. But that's exactly how I come in with a layer of asset protection, separating myself from everything, right? Is now I have all these things owned by entities. Now each entity has its own insurance. Now this provides a layer of protection. If anything were to potentially happen to me or happen to those assets, then it allows a barrier for me not to get sued or caught up into the whole mix. Now, Jack Hayes says, hey, is it possible to acquire a good business score in 6 months? You can acquire a good business credit score in 30 days. It takes 1 month, not 6 months. And here's why. Because business credit scores are primarily based on one thing, how you pay your bills. All we have to do is get accounts that report to the business credit reporting agencies. By the way, I will pull up, I think I have it here. I don't know what just happened here. I will pull up an actual code where you can get a free guide on building your business credit. This thing's been downloaded over 1 million times, pretty popular. So you can build business credit in 1 month's time. It takes about 1 month for you to get credit and for it to report to a business credit reporting agency. So once that happens, now you are able to have an established credit profile and score and start using that to be able to get credit. By 6 months, our clients are at the end of this process. So what I mean by that is that in our world, our clients are getting to the end of business credit building in 4 to 6 months. They're getting Visa cards. They're getting MasterCards. They're getting they're able to get auto financing, all without a personal guaranteed credit check. And they're getting to that very end in only about 4 to 6 months. So you can easily get to the end of the process in 4 to 6 months and build the business credit score in only 1 month or only 1 month's time. So that's how you do it, right? The next thing is you just want to stay informed of financial best practices. Follow somebody that you know, like, and trust. Now, look, I'd love that to be me. The reality is I literally wrote the best-selling on building business credit 12 years ago. That's how long I've been doing this, before TikTok was around or any of this stuff. So I know a lot about this. I've helped going over 100, 200,000 business owners through this process, over 50,000 clients through this process. So I know a lot about the credit and financial game and have done this for a lot of different businesses. So like and subscribe to our channels, and we'll keep you informed of what's going on. New credit lines that are out, new requirements that are out there that you should know about. We'll keep you informed of what you need to know. But whether you follow us or others, find the people you trust and make sure that you stay educated. And that is exactly how we protect your personal credit. We set up an entity separate from us, different address, different phone number, different EIN, different bank account, okay, license for the business, completely separate for us. Then we make sure that we set up that bank account, so running our expenses, our income and our expenses for the business through that. Next, we start getting business credit cards that are in the business name without personal guarantees and credit checks. That helps us build a credit report with Dun & Bradstreet, with Equifax, and with Experian. And again, I will throw up, you can go to creditsuite.com/EIN or just scan this QR code and that will get you the business credit building guide. Now, the next thing that we do is we start being picky. We start strategically choosing for personal guarantees. So we come in and we say, hey, do you require a guarantee? Now that we've got a credit profile and a score, we're getting more credit. We're building that credit profile. We're using the credit we're getting. Our limits are getting higher. Now we start to say, lenders, I don't want to provide a personal guarantee. And we go with lenders that don't require it on a lot of kind of financing, like merchant cash advances and revenue lending. Then we get insurance to start protecting our business, the thing that we set up to make sure it's protected, and we continue to get education as we go. And this process will help us quickly get away from personal credit checks, get away from personal guarantees, and protect our personal credit while we actually grow our business. One other final note as we wrap up. Don't use personal credit cards to try to fund your business. When you do this, you're typically going to find that it's about twice as much money or more to run a business than what you think it will. It will typically take you twice as long as what you think it will to get to certain revenue numbers or start generating the money you want to generate. So if you're using personal credit cards, you're going to quickly max those out. And then that's 30% of your credit score utilization. You're going to hurt your personal credit scores. Then you're going to say, what do I do? I need money. Then it's too late because your personal credit scores are ruined. I see thousands and thousands and thousands of entrepreneurs in that cycle. So if that is you, what you want to consider doing is going and, again, looking at a program like Credit Line Hybrid, which I'll throw up on the screen here, because this will get you away from all of that. This is where you can get real business credit cards to fund your business. And in doing so, we can keep the credit off our personal credit to keep our personal credit scores high for the rare cases we do need to use it. That's why I mean by strategically using personal guarantees and credit checks. It's not that we're going to do away with them. It's that we're going to stop using them when we don't need them, like credit cards, auto financing, right? And revenue lending loans, merchant cash loans. Then that saves our credit for when we do need it. Right now, probably an SBA loan. And so we can save our credit for when we do need it and not use it the 80% of the time we don't need it. That is a smart way to be able to fund your business. But don't get into a hole using your personal credit cards to try to fund your business. Come in and go to creditsuite.com/CLH or just look into business credit cards that don't report on the personal credit reports. It's the easiest way for you to actually be able to come in and be able to start building credit in your business name and not putting balances on your consumer credit, which can hurt your scores. So thanks for tuning in. I'm going to go ahead and wrap up. Now we've walked through how to protect your personal credit. If you got value from this training, like and subscribe. And then I look forward to seeing you on our next training. We're talking about more cool ways to get the money you need